He is Aman. He just started his small business, Aman Cafe. Let's follow his journey and understand accounting step by step.
Aman begins by investing his own money into the business.
We're purchasing equipment like this coffee machine and furniture. That's right. And these are assets, things the business owns. Every transaction must be recorded. This process begins in the journal.
Aman starts making sales. Money coming into the business is called revenue.
To run the business, Aman pays expenses like rent, electricity, and salaries.
Sometimes, Aman buys goods on credit. This creates a liability, money he owes.
Each transaction is recorded using debit and credit rules in the journal. Next, these entries are posted to the ledger, where similar transactions are grouped. The ledger helps us track balances for each account, like cash, sales, and expenses.
Now we prepare a trial balance to check if all entries are recorded correctly.
Adjustments are made for items like unpaid expenses or asset depreciation.
After adjustments, we create an adjusted trial balance. The income statement shows profit or loss by comparing revenue and expenses.
If revenue is higher than expenses, the business earns a profit. The balance sheet shows what the business owns and owes.
Everything follows one rule. Assets equal liabilities plus equity.
At the end, we close temporary accounts to prepare for the next period.
This is the complete accounting cycle, from transactions to financial statements. And that's how accounting helps businesses understand their financial health. Simple, structured, and powerful. Thanks for watching Account Finance with Ravi. Subscribe now for simple and practical finance lessons.